Hey, it's Ryan from the Dividend Investors Club, and this is the market trend tracker for the week of February 12th, 2018. And so the correction of 2018 is upon us. Last week we actually had both the Dow and S&P and Nasdaq all dip into correction territory intraday. So the pullback of 2018 is now the correction of 2018, and the big question I think everyone's asking is it safe to buy the dip yet? And so let's take a look at some of the trends, kind of figure out what our plan of action here is. Taking a look at the market trend tracker here. So, these are these charts on the left here are the ones we've been following. As far back as a month ago, we were saying how high this spread had become between the 50-day and the 200-day, and then the 50-day, and where the actual price of the S&P was. And so what we got is a kind of classic correction where you're testing some of those long-term moving averages. And the week prior so it started heavily a week ago from last Friday, and then obviously we know last week Monday had a horrible day, and it was just continued on Tuesday, had a big up day Wednesday. And then, obviously Thursday was another huge down day. We had 2 days where the Dow was down 1,000 points, or finished down 1,000 points, but the volatility has just been incredible. And so, the question is, where are we in this correction? Is it over? Is it time to buy back in? And so, this chart up here, we clearly busted through the 50-day, went down, tested, 2,600, which, the following day we ended up blowing through that and actually testing the 200-day. So you can see the intraday low here was 25.32 on Friday, but we staged an amazing comeback and pop from that test of the 50-day, which I think is very constructive, and I think it was a very positive move to finish the week, on a high and bouncing off that 50-day. We were only there for probably 10 minutes, and then we had just an incredible move and pop from that level. So I think that's a very positive thing, and I think for the first time since this correction kind of has been upon us, I think that was the kind of biggest positive sign we've seen that we're potentially forming a bottom here. And so the strategy here is to kind of leg into some positions. I think if you have any cash, you should be, buying some good stocks at good prices. I mean, that's our investment philosophy in general. But now is the perfect time to do it. This is you probably won't see prices like this for a while, because I do think what will happen. I don't think we're going to make new highs from here, but I think if anything, kind of the bars have kind of been set. So I don't think we'll make new highs. We may go up and test those highs, and I don't know that we'll bust down below the 200-day. So I think what we found is the top bar and the bottom bar have kind of been set, and I think what we'll do is we'll probably bounce between those levels for a while. And so that's where you got to time some of your purchases here, and when we're down towards the bottom of this range here that we've kind of drawn, those are the times where you want to buy into some sectors that maybe have been beaten down. Focus on value, and that's kind of my overall view of kind of where we are, and whether or not it's safe to buy in. So we could very well test these levels again. But I think the bars have been set, and I think we're just going to kind of bounce around and consolidate and stabilize, in that level. What I'd love to see is the VIX come down in a meaningful way. So the VIX is still at 29. That's still pretty high from a historical standpoint. We did hit a high of 50 intraday, during the initial sell-off on kind of Monday, Tuesday. And then we've kind of come down, but that's, I expected the VIX to come down much further than this, and it hasn't. I would expect it to come down towards that long-term kind of average of 20. And if it dips below 20, obviously that's even better. But we need that VIX to stabilize. so that we're not getting these 1,000-point moves in the market every day, because I think that's going to cause uncertainty, and that's going to cause people to be fearful, continue to be fearful. So I think once this comes down, I think it should give you even more confidence to start putting money to work, and I think we'll probably see that this week. We'll kind of obviously keep our eye on that, but keep your eye on the VIX. And then obviously keep your eye on these levels. But I do truly feel like we've kind of set the low bar and the high bar of kind of that range we're going to be bouncing between. And it's pretty big. It's a 10% range. But I do think that's kind of where we're going to be for the next, probably 6 to 12 months. Another thing to watch, people have been highlighting this, treasury yield and bond yield thing as kind of the culprit of this sell-off. I don't fully agree with that, because in a historical basis, 3% is still extremely low. Yes, we've had a move off the lows, bond yield wise, but 3% is still historically a very low rate. The spread between the treasury and the dividend yield on the S&P 500 continues to narrow a little bit. It did peak over 1%, a few weeks ago. But now that the S&P has sold off, the yields come up a little bit, and we're getting a little stabilization here, I think, in those yields. And if anything, and you can kind of see this in the sector performance, and this is again why we follow the sector performance in this asset class performance. But you can see that even Friday as we rallied, this is the 1 day here, you can see that real estate, utilities were in financials, but these two were actually some of the biggest losers of the previous week or year to date. You can see right here, like real estate and utilities have been a big loser because of these rising rates. But the fact that they were kind of leading the market higher on Friday gives you some comfort that maybe, that fourth rate hike might be off the table. And that's kind of what they've been talking about. Why aggressively raise rates at this point when the market has pulled back and there's some uncertainty back in the market. So we'll kind of keep our eye on that. But I think these are the three biggest charts to follow right now. And I think the conclusion is it's getting a little bit safer to put money to work, and you don't want to put it all to work at once. You want to take little nibbles. One thing that we do when we're buying stock is we think about, our stock purchases in units. And so our biggest position in our portfolio, it will max out about 5% of the portfolio. And that's what we suggest to kind of have that proper position sizing. You never want to be bigger than that. A lot of times we're smaller than that. But we kind of break that 5% up into 5 different units. So if you think about our max, then in a unit perspective, 5 units is our highest. And so what we've been doing, the last few days in this week, as we're buying stock and putting money to work, we'll maybe nibble at 2 units, right? So that translates to about 2% of our portfolio. And so, as the market goes down, and if we can add to those positions at a lower level, maybe we'll add 1 unit at a time, as that stock continues to come down, if it does. If not, we have 2 units at a very good price, and if it rallies from there, great. But that's a good way to kind of manage your risk on the downside. But it also allows you to start putting money to work, because this is the time when you want to do it, and you want to put money to work when everyone in the market's very fearful. And so I think we've gotten down to that point. And again, this market should continue to move higher because of the tailwinds we have of corporate earnings and strong economic growth. Right, this is not something that's been driven by recession fears. This market pullback happened, and the consensus is, it was time for a correction. We got some weird things going on from a technical perspective with, all this stuff with these, volatility ETFs and the automated trading and things like that. So I think that's why it corrected as hard as it did, and the velocity was as hard as it was. But I think that's the new norm. Anytime I think we get a correction in the future, it's going to be fast. It's going to be hard. And, you just need to keep your eye on these levels and keep your eye on the big picture to say, is this upward trend going to continue? I think the answer to that is yes. And, have we probably seen the worst? I do think that 200-day moving average should hold because of all the tailwinds we have behind it. So that's kind of my analysis here. Let's take a quick look before I end the video here, just at the individual sectors. And you can see obviously a big difference here, but what this shows you is that there's opportunities in pretty much every sector right now. And so our focus, and we're actually going to put out a bunch of videos, in the coming weeks of, the stocks that we would focus on after this correction. So the good high quality dividend stocks that we're going to focus on, from a purchase standpoint. And these sector charts kind of help us, figure that out. Consumer discretionary is the only one that's still in an upward trend. Completely. You see that up here in the top left-hand corner in green. So the 50 days above the 200-day, the blue line is above the red line, and then the actual price of that ETF is above the 50-day. So that's the only one that's in that for sure still uptrend, right? The yellows, just mean that the 50-day is still above the 200-day, but the price has dipped below the 50-day. And so you can see all those are yellow. So those are ones that obviously you can look for opportunities, within that sector to find some stocks to purchase. And then the ones that are in red are the ones that are in a true downtrend where the price of that ETF is below the 200-day moving average, and or the 50-day is below the 200-day. And so you can see, we've got 5 sectors here: consumer staples, right here, and then real estate and utilities. Those are the ones that have kind of gotten hurt with that the rise in interest rate fears. And then we've got energy and MLPs that are down because of the price of oil. And so I'll kind of show you that in a minute. But those are the 5 that, if you're really focusing on some deep value, those are the 5 that I would kind of focus on at this point. But if we're thinking about which stocks are probably going to move highest the fastest, it's probably going to be these ones in yellow, because we're still in a decent uptrend, but they've had a nice pullback. So you can probably find some good opportunities there. So I would look across the board, and we're going to highlight some stocks in each sector that I think, make sense from a good value perspective. But I think it's always helpful to kind of see where we are sector-wise, across the board here. So, I'll just point out so you can see, why just that little trend here we're talking about in, let's see. So you can see crude oil down here on the bottom. So crude oil down 9% in the last week. And so it makes sense why, energy and MLPs have been some of the worst performers over the last day and then week as well. So those ones have now become into a downtrend. But that's kind of a mini trend within a trend there. But that's a little explanation behind there. So anyway, that's what I got for the week. I do think it's safe to start nibbling. Make sure you do it in, smaller positions. If you want to think about it in that unit perspective that we think about, I think that's a great way to do it. And then we'll have some good opportunities for you. We'll do some 2-minute trade ideas on some great dividend stocks in the coming weeks. Take care, everyone. Have a great week. I think we all know that the stock market can be a scary place, especially if you're trying to go at it alone. But you don't have to do it. You don't have to be there alone. At the Dividend Investors Club, it's community investors. We're working together to grow and preserve our wealth. So if you like this video, please check us out at dividendinvestorsclub.com. Consider joining the club and joining us. And definitely subscribe to our YouTube channel by clicking the subscribe button below this video. Take care.